kick things off, we want to talk about this great article that you posted pre-retirement about the kind of some of the big things that you learned in the last 27 years writing about personal finance. Can you talk about why it's harder than ever today to be good with money?
I think the reason why it's harder today is that there is more pressure than there ever has been to spend money and to be seen to be spending money. I think the internet sort of laid the groundwork for this more complex environment, and then social media just layered on top of that. And it's sort of, there's, excuse me, fear of missing out. FOMO is not new. It was a concept long before someone coined the phrase. But I feel that with social media, you're seeing what you're missing out more. And I feel like there's just sort of this competition out there to who can live the best life, who can put the best face forward. And I think that is added to the psychological pressure out there that people feel that I must spend. I know I got to save, but I'm going on vacation and maybe I should just crank it up a notch to go somewhere Instagrammable. And I think that, especially for the younger generation, I think that's really weighing on them. And it's like an amplified consumption message, and it increases almost constantly. And you sort of see these counterintuitive things happening in the economy. We know how stressed people are about money because every poll tells us that. And yet you see restaurants are full and car sales are clipping along and travel is really happening. And, I think, yes, there's certainly a segment of the population that's very well situated financially and they're able to spend regardless. But I think people are spending against their best interest. When I look at what's happening with cars and SUVs and the prices people are paying and the payments they're making and the terms on the loans, I think that's the perfect metaphor for this, accelerated consumption world we live in.
Hmm.
Rob, you mentioned in the article as well, people are living longer than ever, but we're all still trying to hit the same financial milestones. Should we be rethinking those traditional timelines of saving for retirement?
Yeah, totally. You know what? When I'm talking about a lot of the challenges in personal finance, I'm always struggling to find something good, helpful, uplifting in a way. And I'm thinking one thing is that longer lifespans give us longer runways to reach all of life's milestones. So you could buy a house in your mid 30s, no problem. You could retire, let's say, instead of 65, maybe aim for 68 or 70. You can extend your education longer to get additional accreditation. You can take a few years to find your feet in the workforce. You don't have to find that great career building job right away. It takes the pressure off. It's like we need to normalize that maybe you don't find your way in your career until 30. You don't get into the housing market until your 30s. Your retirement. Now, I can tell you the concept of early retirement, it might be active in people's minds, but I'm looking at the Stats Can data on average retirement ages. It's now above 65 point something. So obviously, reality, people are coming to grips with the idea, well, to 65. Well, how about pushing it ahead to 70? You live to 95. You're still going to have a block of 25 years retired. Maybe your 65 to 70 years are done at sort of half or two-thirds pace, like I've been talking about. And, it gives you more time to accomplish ththings that you might think along the old timeline aren't doable. If I don't own a house by 30, I'm financially unsuccessful. Well, not true at all. I could map out how you could buy a house at 40 and make it work.
Congrats on an amazing 27 years, Rob.
Thank you.
I'd like to hear you talk about the evolution of financial advice has been available to consumers over those 27 years.
Well, when I started my job, it was mutual fund central. I mean, mutual funds were the financial world. Like ETFs, I think there were like two ETFs in the world. There was discount brokers were there, but you had to call in, and it was the trades were like quite expensive. It wasn't really a thing. So the advisory world were the gatekeepers for investing, and what they had to offer was mutual funds. And there was such an intense sales culture, and it led to such unhappy results. As soon as I started as personal finance columnist and my email was printed in the newspaper, it was like Niagara Falls of complaints and sour comments from people about their advisory experience. And it really hit me hard. I thought, I've got to do something about this. And I wrote a lot of critical stuff on advisors and advice and the sales culture. And it sort of became my mindset. And then I got out and went to events and met, planners and conscientious advisors. And I realized, okay, there is a segment of the industry that is advice forward. And what's happened is that the sales side of things has shrunk and the advice forward side of things has grown. There's just more of a focus on portfolio building and on financial planning and on dealing with the client where they are rather than just dumping a bunch of mutual funds on them. I think that there's been a significant improvement. I don't want to like sound naive and over dramatize how wonderful the advice profession is. There's still a lot of sloppy work out there. There's probably investors. When the market crashes next, we're going to find out how many people had portfolios that were too aggressive because they pared back on bonds because they didn't like interest rates and they were going after tech stocks and all that stuff. That's happening, but I do think that there's more advice to be had than there ever was, and that's a big plus.
So you've documented the shift as it happened over time, from commission-driven sales to proper financial advice. What's your sense of what made the biggest difference? Was it regulation? Was it competition? Was it awareness from consumers?
Well, I think part of it was self-interest. I mean, if you're an advisor and you get a 1% or a 1.5% fee, I think a lot of them discover that if I can get a good client base, I can actually probably have a smoother revenue experience than selling mutual funds by the bunch and getting trailing commissions when people are coming in, they're coming out of funds. So I think there's self-interest, but I also think there's competition. And I don't just mean competition among advisors and financial planning firms. I mean product competition. The rise of ETFs has shown people, yes, I can do this myself. And so advisors are thinking, well, if my value proposition is just building portfolios, that might not be enough to get me the client base I want. So what else can I do? And planning and being planning and guidance and coaching and that sort of thing is where you really where you really generate the value. I mean, like it's a kind of a cheap commodity now, building portfolios. You can just go buy VBAL, and that's probably suitable for quite a high number of people. They don't need anything more than that. And I think advisors are starting to realize that. So they're asking themselves, what else do I have? And advice is the answer.
Now, Rob, that sort of leads into the next question here. Like, you and I have known each other for a long time. I think we probably first met back when I started doing my blog back in 2010. So that's like 15 years ago now. And I've watched DIY investing evolve a lot over that time. Your career has been much longer writing about personal finance. How have you watched DIY investing change from the late 90s till today?
Well, when I started, there was barely any DIY investing. It was real. You could go into your bank branch and buy GICs, and back then interest rates weren't bad. And the banks were just getting started in the mutual fund business, so there really wasn't much of an infrastructure there at all. So you either had an advisor or a broker. Broker was a big term back then. That was like it's kind of fallen by the wayside, but that was big back then. And then there were discount brokers. There was TD Greenline, and all the banks were gradually adding theirs, but it was expensive, and you had to call in. And it was really suited for a very financially sophisticated sort of person. But from there, we had the tech boom in 1999, 2000, 2001, and that prompted a lot of interest from retail people to get into investing. And that is really where, what we now call digital investing or discount investing or online investing, that's where it started to really blow up. It became really big. After the tech crash, it sort of pulled back in a little bit, but you started to see E-Trade come to Canada. That sort of sparked some interest, and Charles Schwab briefly came to Canada, and it started to become sort of a big thing. And side by side with the growth of discount brokers or online brokers was the rise of ETFs. So you had this great vehicle and you had this great product to use, and they sort of grew up together. And now we're at a point now where you can manage portfolios at almost no cost. You could buy index tracking ETFs with management expense ratios of like 0.05 or 6%. You can use an online investing app with no commissions to buy them. This is the cheap, and the irony is it's cheap, but it's also very sound. You can do this. With fractional shares, you could just go flick. I got $50 left at the end of the week. Boom! I'm going to buy, 3.5 shares of whatever asset allocation ETF I'm using.
So you've been a fan of ETFs for a long time. What do you think still holds some people back from embracing them?
I've been a fan of ETFs since they were called index participation units.
Yep.
And I think What's holding people back is the fact that you have to buy them through a self-directed platform. And I think for some people, it's a little bit unnerving to go out there and throw your money into the stock market. And placing the order is a bit intimidating. Now, I mean, I guess if you're younger and you can sort of think of it in a gamified sort of way on an app, it's probably easy. But for a boomer who's never really handled this sort of thing, and you say, I'm going to take over my investing, there's a step to you have to take that step and jump into the unknown of clicking a button, and all of a sudden the dollars you can comfortably see in your account are now in some abstract security that you now own. And just to take this back one level of simplicity, I've talked to a lot of people out there about the idea of like keeping your savings in a high interest savings account with some alternative bank, and they go, well, how do I do that? Well, you just set up an automatic transfer. It's really easy. Like, in fact, the alternative bank probably has let's read the bottom of the check, the numbers there, plug them in here, boom, you got a link set up to it. And it's really easy, but they haven't done that. They haven't really thought it through. They haven't clicked on the information to find out. And then you tell them, transfer money into this brokerage account and start trading. It's a bit of a leap. And I think online investing's come a long way. But I think it could be simpler. I mean, they've made a lot of strides in making it more appealing. They don't say fees and commissions, they say pricing, they say place an order instead of trading. They're trying to use more English, plain English, and I think that's helping. But no one's really thought. Everybody in the brokerage industry wants to appeal to sophisticated traders with lots of money who place lots of trades. But no one's really come up with sort of like the introductory trading screen that you can click on and open that up, and then once you get more sophisticated, you can opt for the more experienced investors trading screen. It's like I think no one's really thought of a transitional idea, and I think if they did, I think that could scoop up a lot of people who are sort of trepidatious about DIY investing.
Rob, I wonder if there's a flip side of the same coin, though, where DIY investing in many ways has become so simple and so easy and so at your fingertips that you can buy and sell individual stocks on your phone, right? Have there been any drawbacks to that ease of investing through those online DIY platforms?
Without doubt. I mean, it's not a perfect solution for sure. I mean, and I think you saw that in, what was it, 2021? Was that like the insane year for the markets when like everything went up, and that was the GameStop year. And I think people were kind of bored, and I think online trading became a game to play, and I think that was happening. People were trading on whim, on news. There was just this link between something I read online on Reddit and investing, and I think that's died off some. I think the markets are in a very speculative froth right now in a lot of ways, but I feel like the retail frenzy has died back a little bit. But there's no question you can make mistakes. But you know what? You could always make mistakes with investing. Like I had an old friend who we used to talk about our investment mistakes. He used to talk about the penny mining stocks he used to buy. He was a young guy, and he met a broker, and he used to call his broker up and place these trades. And of course, he blew his brains out. So I was thinking, and then there was a generation who got overly involved with tech stocks and lost a lot of money. So there's always a trap in the investing environment. But I think by far the greater good is served by having, like, I know there's people saying fractional shares and no cost trading. There's a downside to it, and I can see that there is, but I say it's overwhelmed by the good side.
So, Rob, how realistic do you think investors' return expectations for stocks really are?
I think they are way inflated. The markets have done exceptionally well. And when I look at the 5-year numbers for the S&P TSX Composite and the S&P 500, was like, last I looked, 15% on average annual total return basis. Phenomenal. I mean, I think when I look at the financial planning guidelines calling for like 5 or 6%, I mean, this is like well over double what a good diligent planner might be using in their plans. And I think it's warping people's expectations. I don't have to tell you that they anchor their expectations on what's just happened, and what's just happened has been phenomenally good returns. And I think when you talk to people, I mean, I heard someone in the business of advice talk about using 10% returns in their modeling, and I thought, what? But anyway, I think that is a sense that we can continue this on through. I don't think we can, and I think there's going to be a lot of disappointed investors out there. When the markets went down hard in March and April, I was taken aback by the amount of anxiety that was coming in through reader emails. I don't think I saw that level of anxiety even in 08, 09. I mean, in 08, 09, people barely understood what was happening. Lehman Brothers is going down. Okay, well, what's that? They knew that you could say the financial system was under threat, but it wasn't tangible to them. But the whole Trump thing, and there's still the tail end of the pandemic. People were very jangly, and I feel like they haven't recovered from that. And if the market were to tank at some point and not pop right back up again like it's did in 2020 and earlier this year, that I think there's going to be a lot of really bewildered and angry and upset people who thought they had amazing portfolios and now realize no, they actually didn't.
Yeah, no, I always felt people's expectations for the long-term expected returns on stocks are often in the ballpark. I mean, they might be saying 10, 11% when it should be maybe 7 or 8. But I think what people are truly unprepared for is the volatility that you need to endure in order to get those long-term returns.
You are so right about that. My sense is that, and it was really hammered home to me in March and April, is that people think that the smart money sidesteps the market downturns. They think, I don't want to participate in that part of stock market investing. I'll just take the good years, please. They really do. Like there was so much talk of getting out. I'm getting out of the market. And I'll tell you, there was a lot of smug readers who said, oh, I got out of the market, in January when I saw Trump got elected. And I was thinking, when did you get back in? Like a week ago? And, it's just like, there's nothing sure than the disappointment of the person who got out early, because eventually there's going to be massive regret. But people like I think that there's the work of teaching people that markets are good and bad, but there's a lot more good than bad. But the bad does happen. I don't think we've made a lot of progress in that. In fact, it might be worse than it used to be. There's just the past 5 years have been too good in a way. And when I think of a reversion to the mean on returns, I think that's some nastiness ahead. There's going to be a pretty sharp period of downdraft, and that's how we're going to get back to our usual average annual.
It's probably worse than the last 5 years, right? Because we've had, what is it, 15 longer of pretty good markets. And then you alluded to this, Rob. The one downturn that we did have, the big one, was COVID, and it bounced right back. And so people are conditioned that that's a downturn, but it's not.
Yeah, you know what? We could have a downturn like remember the S&P 500 after the tech crash? Like that was a wasteland for I think they have 3 consecutive down years. I remember when the U.S. equity category was so bad that there were investors thinking I would never bother with that. I'll just have Canadian equities. The energy was strong.
You're right.
The U.S. was like, if you go back to those years, it's shocking. It was just an epically bad period of investing. And I make no predictions about what's to come, but when you've seen these twists and turns, you can't help but think something similar, unpredictable but shocking, will happen, and it will rewrite everybody's thinking about portfolios for a while, until the next big rush comes. But I think basically it's not everything is working right now, but enough is working that you're thinking there's money out there to be made. Just scoop it up.
But you're right, Rob. I remember those days when clients would ask, "Why do I need U.S. stocks?"
Yeah, it was. Yeah, no, I remember the Canadian market just trounced the American market for a few years, and it equalized, and then they surpassed us. But I noticed if you look at the 5-year numbers, and I think if you look at the S&P in U.S. dollars, we're right in line with them over the past 5 years. 15% returns for all.
Do you think the media has contributed to unrealistic expectations?
The media has a role, but the media, it's a feedback loop. Okay, the media reports on the great gains, and then investors read about in the media about the great gains and think, I got to get me some of that, and then they jump in, and then the market goes up more, and then the media reports on that. But you know what? The people are like the readers of the Globe Mail, where I've worked for almost 29 years, are keenly interested in the markets, and it's our duty to report what's happening there. And believe me, when the markets were plunging, we were right all over that too. I remember 2008, 09 was just like writing these crisis columns, and I was thinking like things I'd never seen before, talking to people who'd never seen these things before. And we play it as it lays. And right now the story is like money flying through the air, just get some. And maybe we should be, maybe columnists such as myself should be, trying to calm people down. But, people do not listen to that sort of thing. It's not to say it shouldn't be said, but people hear what they want to hear. And, you could tell them temper expectations, but when the market falls, the amount of shock that's going to be out there will show that no expectations were actually tempered.
Is there a way, Rob, to kind of get past the cliche of stay the course? I mean, this is a message that we all want to get out there, but as you said, I think people have a limited appetite for that message, and it sounds a little bit too pat. Can you take it to another level and help it sink in a little bit deeper?
I think that, I wonder if maybe the idea of this as a buying opportunity needs to be played up, because, the concept of the bargain of buying things marked down is well understood. Now in investing, it's, and you know what, you said, is the media to blame before? I'll put a lot of blame for for not being open to bargain hunting on the investment industry, and all these people saying, "Oh, don't catch a falling knife. It's not time to get back into the market." John Templeton, when he was talking about buying when others were fearful, he didn't talk about the falling knife. But I mean, it's like you talk out of both sides of your mouth. You say, "Oh, you got to buy when it's down, but don't catch a falling knife," and people are picking up on that, and they're thinking it's not time. These pros aren't buying, and I think if you say let's buy on the installment plan when things are down, and this is a fabulous time to be buying. I think that might turn it into an active thing instead of a passive thing. Just sit there and take the pain. It's like we are out there hunting for those double-digit returns that you're going to get because you bought at market lows. I mean, in my career as a personal career as an investor, if I were to pick my number one regret, it would be not pouring more money in at market bottoms. You know what? It's like when I've done it, and I'm no genius about picking bottoms, but I did invest, blocks of money for my wife and I at low points, and it did fabulously well. You give it like 2 years. Now there's moments when you feel like an idiot. I can't believe I put money in and it just plunged. But if you can take the long term, I mean, it is a way to give clients or investors really good results. And these are the results that make them feel like they've tapped into some expertise, and the expertise is just following basic investing wisdom. Anyway, I do think we tentatively talk about, oh, this is buying low and there's bargains out there. But I think maybe maybe turning stay the course into charge ahead is something. You know what? And I know the investment industry has a million examples. If you bought at market lows, I mean, stop doing them at the market bottom and do halfway to the market bottom and say over 2 years, look how much people made. It's you want to turbocharge your returns, do that.